Spending Somebody Else's Money, Part 2, Budget Presentation.
Now that we've talked about the two types of non-expenditure transfer and have seen a sampling of legislative authorities, let's take a look at how we present expenditure and non-expenditure transfers in the SF-132, or apportionment, the SF-133, or report on budget execution, and the program and financing schedule in the President's budget. Both types of transfer affect budgetary resources, which are reflected in line numbers in the 1000 series. These appear on the SF-132, the SF-133, and the P&F, or Program and Financing Schedule. Let's review what makes up budgetary resources. Budgetary resources are made up of two major elements: unobligated balances and budget authority. Unobligated balances, on line numbers starting with 10, are actually unexpired budget authority. That is, funds with an availability of more than 1 year, like multi-year and no-year accounts. Budget authority is made up of 4 elements: appropriations, on lines starting with 11 and 12, borrowing authority, on lines starting with 13 and 14, contract authority, on lines starting with 15 and 16, and spending authority from offsetting collections, on lines starting with 17 and 18. Since HHS has little borrowing or contract authority, we'll focus our discussion on appropriations and spending authority from offsetting collections. Because non-expenditure transfers appear first in the line numbering, let's cover them first. Let's walk through the lines used most frequently. We'll use Appendix F in OMB Circular A11. Lines reflecting non-expenditure transfers of prior year appropriations, otherwise known as unobligated balances, appear in the 1000 range. The actual non-expenditure transfers out of appropriations is reflected on line 1010, unobligated balances transferred to other accounts. Since these amounts are negative, budgetary resources are reduced. The actual non-expenditure transfer in of appropriations is reflected on line 1011, unobligated balances transferred from other accounts. Since these amounts are positive, budgetary resources are increased. Since we're focusing primarily on spending somebody else's money, we're mostly interested in amounts transferred in. Until actual transfers are accomplished, the apportionment and the SF-133 might reflect anticipated non-expenditure transfers, in or out, on line 1040, anticipated non-expenditure transfers of unobligated balances net. Since anticipated amounts have to be closed by year end, note that there should be no entry on this line at year end. Since the program and financing schedule is based on year-end balances, you will never see anticipated transfers in the P&F schedule. It's important to note that there is no line 1000 distinction by line number of discretionary and mandatory unobligated balances. So OMB requires us to use a line split to differentiate those amounts if you're dealing with an account that has both types of balances. Lines reflecting non-expenditure transfers of new appropriations appear in the 1100 through 1200 range. This includes both types of non-expenditure transfers: transfers of authority to obligate and allocations of authority to obligate. The actual non-expenditure transfer out of discretionary appropriations is reflected on line 1120, appropriations transferred to other accounts. Mandatory appropriations are reflected on line 1220. Since these amounts are negative, budgetary resources are reduced. The actual non-expenditure transfer in of discretionary appropriations is reflected on line 1121. Appropriations transferred from other accounts. Since these amounts are positive, budgetary resources are increased. Mandatory appropriations are reflected on line 1221. Again, since we are focusing primarily on spending somebody else's money, we are mostly interested in amounts transferred in. Until actual transfers are accomplished, the apportionment in SF-133 might reflect anticipated non-expenditure transfers, in or out, on line 1151. Anticipated non-expenditure transfers of appropriations net. Mandatory appropriations are reflected on line 1251. Since anticipated amounts have to be closed by year-end, there should be no entry on this line at year-end. Since the program and financing schedule is based on year-end balances, you will never see anticipated transfers in the P&F schedule. Because allocations are made in parent-child relationships, and these are combined for budget presentation, these non-expenditure transfers do not appear in the P&F schedule. To reiterate, the location of these lines in the budgetary resources section of the apportionment, SF-133, and P&F schedule means that transfers in increase our budgetary resources, and transfers out decrease our budgetary resources. Let's take a look at an example. In this program and financing schedule for the Prevention and Public Health Fund, we can see that the account received a mandatory appropriation of $1 billion on line 1200 and transferred funds out on line 1220 to 4 different accounts. $28 million was transferred to account 750142. That's the Administration for Community Living. $7 million was transferred to account 751700, the Agency for Healthcare Research and Quality. $831 million was transferred to 750943, CDC. And $62 million was transferred to 751362, SAMHSA. Note in each case that the Prevention and Public Health Fund account is reduced by each transfer out, and the receiving account is increased. The budget presentation for non-expenditure transfers that allocate the authority to obligate does not use lines 1120 and 1220 or 1121 and 1221, since the allocation account is a parent-child relationship. This means that for presentation in the budget, these amounts are only reported under the parent account. In this example, although the Medicaid account allocates funding for vaccines for children to CDC, note the transfer on line 1220, these funds are simply included in the total of the parent account, Medicaid, in the President's budget. We can see that the total appropriation on line 1200 has not changed. We can also see the vaccines for children child activity listed as one of the Medicaid program activities. Now, let's take a look at how expenditure transfers are reflected, and things get a bit more interesting and complicated. Because spending authority from offsetting collections increases our budgetary resources, We also expect them to be reflected in the Budgetary Resources section of the apportionment, the SF-132, the Report on Budget Execution, SF-133, and the Program and Financing, or P&F schedule, in the President's budget. We already know that budgetary resources have line numbers that are in the 1000 series. Now, let's walk through the lines used most frequently for spending authority from offsetting collections. Let's go back to Appendix F in OMB Circular A11. The first thing you will notice is that, unlike non-expenditure transfers, there are no line descriptors reflecting the words expenditure transfer. But given that expenditure transfers are the mechanism used for spending authority from offsetting collections, let's take a look at lines reflecting spending authority. These appear in the 1700 through 1800 range. As you will soon see, it makes more sense to look at these lines in reverse numerical order. Anticipated spending authority from offsetting collections appears on line 1740 for discretionary collections and 1840 for mandatory. Note the definition: the amount of the current estimate of anticipated collections expected for the remainder of the year. This means that when you arrive at the end of the fiscal year, you can no longer anticipate this authority, and no amounts should be on these lines on the September 30th report. That's why you don't see line 1740 or 1840 on a program and financing schedule. Note here, we finally see the term expenditure transfer. The next frequently used line is 1701 for discretionary and 1801 for mandatory. The descriptor tells us these lines represent a change in uncollected payments, federal sources. Amounts on this line represent the amount of earned reimbursements from another federal government account that has not been collected. Accountants call this amount receivable. That means that work has been done based on an agreement between federal agencies, that is, earned, but has not been collected. An entry on this line reduces the amount previously anticipated on line 1740 or 1840. The next step is, of course, collecting the funds. And this is shown on line 1700 for discretionary and 1800 for mandatory. Note the definition is offsetting collections credited to expenditure accounts by law. Also, amount of reimbursements or other income earned and collected to date during the current year, including those for revolving funds. As funds are collected, the receivable on line 1701 or 1801 is reduced. Before we look at an example, let's stop for a moment and summarize where we are. We've been discussing three different types of budgetary resources: unobligated balances, appropriations, and spending authority from offsetting collections. We've pointed out that there are two very different mechanisms used to establish the movement of these budgetary resources: the non-expenditure transfer and the expenditure transfer. We see the unobligated balance transfer lines, the appropriation transfer lines, and the spending authority from offsetting collections lines. We've not included the anticipated lines because these do not actually create a budgetary resource. They only anticipate its creation. Note also that while the establishment of the receivable does create spending authority, the expenditure transfer doesn't occur until funds are actually collected. Let's take a look at an example to see how these lines work in a real situation. Here's an apportionment for the Office for Civil Rights. Note that the total discretionary spending authority from offsetting collections is a little over $1 million on line 1700, plus $4.7 million on line 1740, for a total of roughly $5.7 million. On the SF-133, we can see that these amounts match the amounts reported as of the end of the third quarter. However, by year-end, note that only $5.2 million was collected. Since no anticipated resources can remain at year-end, the total discretionary spending authority from offsetting collections is reduced to the $5.2 million collected. Let's pause for a moment and compare our two ways of spending somebody else's money. You will recall that with the non-expenditure transfer, the resources in question can only appear in one account or another. When funds are transferred, the budget authority in the losing account is reduced by the same amount. The budget authority in the receiving account is increased. In addition, the color of the money may change. However, with the expenditure transfer, the resources must appear in both accounts. They have to be available to the paying organization in order to obligate and pay the receiving organization. They also have to be available to the receiving organization in order to obligate and pay for the good or service they are providing to the paying organization. The money does not change color. With the expenditure transfer, the resources are counted twice. When the budget's presented, we don't want to count the same resources twice. So how do we avoid that? OMB Circular A11, section 20.7D tells us, where accounts have offsetting collections, the budget shows the budget authority and outlays of the account both gross, before deducting offsetting collections, and net, after deducting offsetting collections. Let's take a look at the lines that accomplish this. This section that accompanies the offsets is this one, budget authority and outlays net. This is the 4000 series of lines. These lines appear in the Standard Form 133 and the Program and Financing Schedule, but do not appear in the apportionment, the SF-132. First, we have to calculate gross budget authority and outlays. Then we will subtract out the offsetting collections to arrive at net budget authority and outlays. All discretionary budget authority is added together on line 4000. Note that this amount equals the sum of discretionary budget authority on the 1100 lines, appropriations, and the 1700 lines, spending authority from offsetting collections. In case you're wondering, the 1300 lines are borrowing authority and the 1500 lines are contract authority. All mandatory budget authority is added together on line 4090. Note that this amount equals the sum of mandatory budget authority on the 1200 lines, appropriations, and the 1800 lines, spending authority from offsetting collections. 1400 lines are borrowing authority and 1600 lines are contract authority. Discretionary outlays from new authority appear on line 4010, and mandatory outlays from new authority appear on line 4100. Discretionary outlays from balances are on line 4011, mandatory 4101. Now we know the total amount of budget authority and outlays from all sources. Next, we want to identify the offsetting collections against this gross budget authority and outlays. First, we identify the discretionary offsetting collections from federal sources on line 4030, mandatory on 4120, and discretionary offsetting collections from non-federal sources appear on line 4033, mandatory on line 4123. The next section is labeled Additional Offsets Against Budget Authority Only. These offsets apply only to budget authority because no collections are involved. Line 4050 and 4140 relate to amounts owed to the account but not collected, referred to as receivables. Since receivables are budget authority, we offset them only against budget authority. Note that the definition states that the amount on this line equals the amount on line 1701 or 1801, respectively, with the opposite sign. Adjustments to receivables in expired accounts would be reflected on lines 4051 and 4141. Offsetting collections credited to expired accounts would appear on lines 4052 and 4142. Because collections on line 4030 or 4120 include all years, in order to properly calculate the current year net budget authority, we have to deduct those collections related to receivables in expired accounts. Let's look at a simple example to see how this works. Let's assume we have two accounts, a paying account and a performing account. To make this simple, let's assume the paying account has an appropriation of $100 and plans to spend all of its appropriation in a reimbursable agreement with the performing account. In the budget presentation for the paying account, we see $100 in total obligations, funded by an appropriation on line 1100 of $100. Let's further assume we outlay $90 by paying the performing account for the work done during the year. Our resulting net BA is $100 and outlays are $90. Now, let's look at the performing account. Again, we see $100 in total obligations. There is no appropriation. In our example, the performing account receives all of its spending authority from the paying account. We see this authority on lines 1700 and 1701. $90 is reflected on line 1700 as spending authority from offsetting collections that has been collected, and $10 is reflected on line 1701 as spending authority from offsetting collections that has been earned but not yet collected. Total budgetary resources equal $100, just like the paying account. At this point, we have double counted the BA and outlays, since both accounts show $100 in gross BA on line 4000 and $90 in gross outlays on line 4020. But then we make the offsetting collection entries in the performing account. We enter an offsetting collection on line 4030 of $90 and the receivable of $10 on line 4050. Note these are the same amounts as lines 1700 and 1701, but with the opposite sign. Following our OMB instructions for these entries, we subtract the $90 offsetting collection and the $10 receivable from our gross BA. This results in 0 net BA. We subtract the $90 offsetting collection from our gross outlays, resulting in 0 net outlays. We have now eliminated any double count. Let's return to our Office of Civil Rights example. Recall that the final SF-133 reflected collections of $5.2 million. Let's look at our offsetting entries on the 4000 lines. Note the $5.2 million collected offsets the gross budget authority and gross outlays, reducing gross BA from $43 million down to $38 million, and reducing gross outlays from $34 million down to $29 million. We've covered the use of the non-expenditure transfer and expenditure transfer in spending somebody else's money. But before we wrap this up, let's quickly touch on two other processes one might consider examples of spending somebody else's money that do not require a transfer of funds from one account to another: reprogramming and intra-departmental delegation of authority, or IDDA. Let's talk about reprogramming first. This is the GAO definition. Note that a reprogramming shifts funds within an appropriation or fund count, distinguishing it from a transfer, which involves shifting funds from one account to another. Because no other Treasury account is involved, there is no augmentation and no expenditure or non-expenditure transfer is required. Total budgetary resources in the budget presentation are not affected. Another difference worth noting is that agencies may reprogram without additional statutory authority. However, statutory notification requirements do exist. The OMB explanation of the difference confirms GAO's point, but raises another. A transfer is distinguished from a reprogramming in that a reprogramming always involves the shifting of budgetary resources within a Treasury account, whereas a transfer usually involves the shifting of budgetary resources between two Treasury accounts. What do we mean by usually? What's an exception? OMB goes on to say, the shifting of budgetary resources within a single Treasury account would be considered a transfer if the action moves budgetary resources between separate statutory appropriations. A good example of this might be changing the amounts in statutory earmarks, such as FDA. Here we can see that FDA has many statutory earmarks. Specific amounts for the Center for Food Safety, Center for Drug Evaluation, Center for Biologics Evaluation, etc. Because these are specific amounts in law, statutory earmarks are treated like separate appropriations, so it's not permissible to reprogram funds between them. Congress does give FDA permission to transfer funds from one specified activity to another with prior approval of the Appropriations Committee. It's important to note that this use of the term transfer is an anomaly to the general understanding of the term, since it does not require the movement of funds from one Treasury account to another in the classic sense of transfer. So, what's an intra-departmental delegation of authority, or IDDA? The IDDA is a delegation of authority to obligate and outlay funds within HHS. It's generally used when no statutory authority exists to use a non-expenditure or expenditure transfer. For example, the Secretary receives appropriations in the Public Health and Social Services Emergency Fund, which are to be used to cover a variety of emergencies in the department. When Congress does not provide statutory authority to transfer the funds, the IDDA is the only alternative to get the funds out. Essentially, the Secretary is delegating her authority to spend the funds to the most appropriate optive. Sometimes it may be NIH, sometimes CDC, sometimes others. It's like handing over your credit card to someone else to use. Similarly, since the IDDA is merely the delegation of authority to spend somebody else's money, the issue of augmentation doesn't really arise. No expenditure or non-expenditure transfers involved, and the budget presentation is not affected. So, there are three major differences between transfers and reprogramming, or IDDAs. With a transfer, a movement of funds between accounts is required. With a reprogramming or IDDA, no transfer is involved. Transfers require statutory authority, but neither a reprogramming nor IDDA requires statutory authority from Congress. There are, however, statutory requirements to report reprogrammings to Congress in a timely manner. From a budget presentation perspective, transfers affect the budgetary resources, while neither the reprogramming nor the IDDA would cause a change of resources on an apportionment, SF-133, or budget program and financing schedule. Okay, let's sum up. This presentation has focused primarily on the permissible augmentation of Treasury accounts, spending somebody else's money. We've investigated exceptions to the 1950 prohibition that no funds made available under this or any other act shall be withdrawn from an appropriation for credit to another except as authorized by law. And we have found that there are laws that permit augmentation under certain circumstances, and these may be accomplished by transfer, either expenditure transfer or non-expenditure transfer. In addition, reprogramming and IDDAs are examples of what might be described as spending someone else's money that are not considered as augmentations and therefore do not require congressional permission.
The end. For more information, check out section 20.4J and Appendix F in OMB Circular A11. Thanks for listening.